Hello, this is Mr. Smith, and this is for the fourth unit of economics for academic government economics, and this is talking about the financial sector. And so first we'll start with the monetary policy. And today we'll talk about the demand for money, the shifts in the demand curve, and equilibrium interest rate. And this is important because we need to think of money just like any other good or service, that there is a demand curve and there is a supply curve, because there is a demand for money, people who want to use it, and then there is the supply of money, which is carried out by the government, in particular, usually a central bank. And so we'll go over a few things that is involved in monetary policy, which is controlled by the Federal Reserve, including the reserve ratio, how much money that banks have to keep, the discount rate or the minimum interest rate set by the Fed, and the federal funds rate, which is an interest rate set by the Fed at which commercial banks borrow and lend their excess reserves to each other, because the banking system is kind of like a network. And the open market operations are one of the chief monetary policy committees that exists within the Federal Reserve. We'll talk about setting and achieving the interest rate targets. So how do they exactly have that to happen, and how do they execute expanding the economy through monetary policy and restricting the economy through monetary policy, and why would they do that? And lastly, the Taylor rule. So first, let's look at the impact of Federal Reserve policies. The impact of monetary policy on aggregate demand, prices, and the real GDP. So we're talking about aggregate demand and aggregate supply. We're talking about the total amount of supply and demand that happen within the economy. We'll also be talking about the effects of expansionary monetary policy, restrictive, and the limitations that it has, and how it's linked to inflation. So first of all, let's look at the historical Federal Reserve policies. And this is a picture of Paul Volcker, who basically was one of the biggest fighters against inflation. And the Federal Reserve started to become more part of the news in the late 1970s because inflation had grown so high into double digits in the United States, which is unusual, at least in modern times. And so Paul Volcker and the Federal Reserve had to use a restrictive policy in order to fight inflation. And that was very controversial because that involves shrinking the economy, which causes unemployment to go up. But even if people were working, though, their savings were being depleted. And so that was a huge problem and one of the major impacts of the Federal Reserve since the Great Depression. And then Alan Greenspan took over and looked over the Federal Reserve during one of the biggest expansions in modern history over the American economy during the technology boom, followed by Ben Bernanke, and then who was followed by a Federal Reserve chair known as Yellen, and then Powell underneath the Trump administration. So there's been a few Federal Reserve chairs since then, with shorter terms than had existed in the past. Here we can see the shift of the demand curve. And so whenever we have money, for instance, it just like any other object can be plotted out. We can look at the price or value of that money. We can look at the supply of it, and we can look at the demand of it. And the supply, of course, happens through the Federal Reserve and the United States Treasury, and they determine what the supply of money should be. And you should basically see when the supply increases, for instance, it would move in this direction. And for instance, if it moved over this way, it would intersect demand at a lower point, and the value of the money would be worth less. So the supply of money, just like anything else, when the supply increases, the price decreases. And the demand for the money, if the demand for money increases, then as you can see here, the price or value of the money increases. So it follows the same supply and demand rules as other types of goods and services. And of course, when the law of demand would also work, for instance, then the price is high, the demand for money is going to be lower, as you can see the quantity here. And then when the price is low, the demand for money is going to be higher. So people are going to want to demand more of it. And then supply is the exact same thing. As the price goes up, supply goes up. And this is because the value of it, and they're going to want to put more out in order to combat inflation. But we'll talk more about that later. Anyway, the graphing that you can see here is It shows the supply and demand curve. And the demand increase that you can see taking place from D1 to D2 would be an example, for instance, hopefully, of the expansionary policy that takes place. But we'll talk about that more in a little bit. But money, specifically when we're talking about the control of money, has to keep track of the demand. In economics, the demand for money is the desired holding of financial assets in the form of money, such as cash and bank deposits. In other words, how much do people want this cash? So the demand is generally equated with cash or bank demand deposits, so what people are putting into those types of entities. Generally, the nominal demand for money increases with the level of nominal output and decreases with the nominal interest rate. And so interest rate, of course, is the price paid for borrowing money. So when we talk about money, and specifically we're talking about the demand, money is necessary in order to carry out transactions. So people will want it in order to carry out those transactions, in order to buy things. However, inherent to holding of the money is the trade-off between liquidity advantage of holding money and the interest advantage of holding other assets. So what we mean by other assets is investments that you could have, or perhaps things like bonds or stocks, for instance. How much interest are you going to earn off of those? Is that more valuable than to keeping a hold of your money in order to making those transactions? So when the demand for money is stable, when people constantly want it and want to have cash on hand, monetary policy can help to stabilize an economy. However, when the demand for money is not stable, real and normal interest rates will change and there'll be economic fluctuations. And so, in other words, if lots of people have their money in stocks and bonds, then changing the supply of money with interest rates and things like that isn't going to be as reflective as they might want it to from the Federal Reserve standpoint. So interest rates are the payments, basically, for borrowed money. So when banks loan money, they're providing you with a service. And so you're paying them for that service of loaning the money by paying back interest. And so the higher the interest, the more money it's going to take out of your hands. And so the fees are going to be greater. It is viewed as the cost of borrowing money. Interest rates and their target, specifically what the Federal Reserve is trying to achieve with them, is a tool of monetary policy. The quantity of money demanded varies inversely to the interest rate. So central banks in countries tend to reduce interest rates when they want to increase investment and consumption in the economy. So if they want more people to buy more things, more cash to be changing hands, they're going to want interest rates to be lower. However, that can create too much excitement or overheating in the economy. And so more investments can be made that maybe aren't worth it. And more people can incur more debt. And if people aren't able to pay all that back, then that could lead to some type of economic crisis. So it can be dangerous to lower the interest rates too much. And the interest rate is adjusted to keep inflation basically in check. So that also had to be taken into consideration. So you could destroy the economy if it gets too low. If you raise interest rates too high, you're going to be taking cash out of the economy to help control inflation. And if that takes place, you have to then worry about people will stop borrowing money. People will stop buying things. Businesses will stop expanding. So there's dangers about the interest rates becoming too low and interest rates becoming too high. When the demand of money involves desired holding of financial assets, so other types of things like stocks or bonds, the money supply is the total amount of monetary assets available in the economy at a specific time. So it depends upon their availability. Data regarding money supply is recorded and published because it affects the price level. So people want to know, is the government putting out too much money? Because that will impact inflation. It will impact the exchange rate, how much that money is valuable in comparison to other currencies, for instance. And then also how the business cycle is performing. So monetary policy impacts both the supply and demand of money. Expansionary policy, expanding the economy, increases the total supply of money in the economy more rapidly than usual, and contractionary policy will slow the money supply and decrease that. In the United States, this is all controlled by the Federal Reserve. The Federal Reserve is the central banking system in the United States. At other places, it might be called the Bank of England or the Bank of Germany, whatever. But here it's called the Federal Reserve. It's an interesting organization because it's actually authorized by Congress, and the officials are appointed by the president and approved by the Senate. But otherwise, most of it as an entity is within the private sector. It's made up of member banks that are nationally chartered banks that are private organizations. They're owned by shareholders. They're out to make a profit, but they come together, even though they're competitors, in order to help operate the Federal Reserve. So the question is, the Federal Reserve keeps track of all this, but obviously the economy mostly operates on its own. So the change in the demand for money is going to happen without the Federal Reserve. It's just going to happen because of different variables. So what are the variables that will cause demand to change? Well, disposable income. People making more money is going to increase demand for money. People making less money is going to change that as well. Tastes and preferences. People wanting to spend more can be influenced by advertising and fads that are happening with products. Changes in expectations. Do I need to hold on to my money because times are going to be tough in the future? Or is something going to happen to this money in the future, so I better spend it now? Changes in prices of related goods. Especially if there's a whole collection of goods that are incredibly related and the price on one goes up, dries up all the prices on the others, that can change also the demand for money. And population size, because obviously the more people there are, the more demanded money is going to be. And it could also include substitutes, what other people can use instead, complements, and also whether or not consumer income is related to normal goods or inferior goods. All of that can change the demand for money. So the demand curve shift. The demand for money is a result of the trade-off between the advantage of holding money as cash that you can spend it immediately. This is known as liquidity because money that you can spend easily and quickly is kind of like water, freely flowing. So cash that you can spend right away is known as having high liquidity. And the interest advantage of holding other assets. So if you put money in stocks and bonds, that means that money is locked up and you don't have liquidity with it as easily. And so maybe you're doing that because you can make a lot of interest. Stocks and bonds are basically government or corporations borrowing money from you. And so they have to pay you back with interest. And so can you make more money off those things in particular? The demand for money determines how a person's wealth should be held. When the demand curve shifts to the right and increases, as it shows here from D1 to D2, there's a liquidity advantage to holding on to money. Likewise, when the demand curve shifts to the left, so let's say it's going the opposite direction of the arrow from D2 to D1, it shows a decrease in the demand for money. The nominal interest rate declines, and there is greater interest advantage in holding other assets instead of money, because often the equilibrium is also where the interest rate will be. And the interest rate is the rate at which interest is paid by a borrower, once again, to a lender. The equilibrium is reached when the supply of money is equal to the demand for money. Interest rates can be affected by the monetary and fiscal policy, but also changes in broader economic and money supply. So factors that can influence the interest rates. Interest rates fluctuate over time in the short and the long run. Within an economy, there are numerous factors that contribute to the level of an interest rate. Here we can see the fluctuation in the interest rate in Germany from 1967 to 2003. So interest rates can fluctuate over time as a result of numerous factors. In Germany, interest rates dropped from 14% in 1967 to almost 2% in 2003. So you can see a high point and a low point. The graph illustrates the fluctuations that can occur in the short run and long run. Interest rates fluctuate based on certain economic factors. So what can influence them? Well, political gain, both monetary and fiscal policies can affect it. And of course, if the central bank isn't independent from the political body like Congress, then there's a possibility that politics can influence both those things. Consumption can also change interest rates because that changes the level of demand for money. Inflation expectations. Once again, if people expect prices to go up in the future, that can impact the willingness of lenders and borrowers to basically do both those things, lend and borrow money, given at certain interest rates. Because will the interest rates go up in the future? If they're expected to be higher, people want to borrow now. But the lenders won't want to lend right now because they know they'll be able to make more money off of it in the future. So taxes can also impact this because it will change the willingness of people to consume if taxes are higher, and that can impact, of course, money supply and demand and also the interest rates. So let's talk about some of the monetary policy tools of the Federal Reserve, and there's a picture of it right there. One of them would be the reserve ratio. And this is when the Federal Reserve, and other central banks can do this too, sets a ratio, a percentage of customer deposits that a bank is required to keep. So what is the percentage of cash that banks have to keep in their vaults? And for example, if a reserve ratio of 20% is required, it will result in 80% of that deposit being loaned out, because that's how banks make money. So if you put $100 into your bank account and there's a reserve ratio of 20%, it means they only have to keep $20 and they loan out the other 80. And then the borrower pays that back with interest, and that's how a bank makes profit and continue to operate. So that is the reserve ratio. So obviously, if that ratio is lower down to 10%, then the bank can loan out even more money. And that turns into a multiplier effect because going back to that original example, 2080, that $80 can be loaned out. Then the person that borrows it puts that money in their bank account, and then 80% of that can be loaned out in turn, and it creates this ripple effect. The next thing I want to mention is the discount rate, and this is the rate at which member banks charge each other. And so a lot of people don't realize this, but banks loan money and transfer money back and forth to each other all the time. The Central Bank of the United States, the Federal Reserve, is one of the biggest lenders, and that next in line, of course, would be the nationally chartered banks that belong to it as members. And these types of operations can influence the supply and demand of money as well. The discount rate is what the central bank actually controls. It is the rate that central bank charges its member banks to borrow overnight. However, the rate of the central bank actually cares about more is its federal fund rates. That is the rate the banks charge each other and is influenced by the discount rate. So those two are intertwined. So that's important to remember. Once again, the discount rate is the rate that the central bank actually controls. It is the rate the central bank charges its members to borrow money overnight. The federal funds rate is the rate at which banks charge each other, and that is influenced by the discount rate. So if the Federal Reserve charges a higher discount rate from borrowing from it, and let's say USA Bank, number one, borrows money from the Federal Reserve, and the discount rate is higher, it is also when it loans money to Pennsylvania People's Bank, a smaller bank, when it loans money to it is going to have to charge a higher interest rate to it as well. So that's how the discount rate can influence the federal fund rate. The Fed targets the rate for federal funds specifically through its open market operations, which we'll talk more about here in a little bit. So, looking at the open market operations, that involves the activity of the central bank to buy or sell government bonds on the open market. The central bank uses them as a primary means of implementing monetary policy. Here we can see U.S. Treasury bill yields, the buying and selling of U.S. Treasury bills on the open market. So the Federal Reserve hopes to change their yields, in which they will affect interest rates in the broader market. So they use these bills and bonds in order, which is a form of borrowing, which is paid back with interest. This helps out with determining what interest rates will be. In the U.S., this is primarily controlled by the Federal Reserve Bank of New York, the largest of those. It conducts the open market operations. And they're under oversight by the Federal Reserve Open Market Committee, or FOMC. It makes a plan for the operations over the short term, and they have regularly scheduled meetings. Historically, the Federal Reserve has used open market operations to adjust the supply of their reserve balances to keep the federal funds rate in a certain place that they wish. The interest rate at which depository institutions lend reserve balances to other depository institutions overnight around the target that is established by the FOMC. So the Federal Reserve, mostly through the Federal Reserve Bank of New York, oversaw by the FOMC, the Federal Reserve Open Market Committee, basically operates these open market operations, to use the word redundantly, through the sale of Treasury bills and bonds. And so this isn't the Federal Reserve backing up with a dump truck and pouring cash into the economy or taking out of the economy. It's doing this through Treasury bills and bonds. And here through this chart, you can see these bills and bonds for a period of 1 month or 10 years or 30 years. And you can see over the short run, particularly, this is through 2009. And this was, of course, during the Great Recession. The percent yield, that, of course, is much lower. And that's often what happened is the interest rates were lowered considerably because they wanted some type of expansion in the economy. And then, of course, you can see they're much higher for these longer periods of time. And you can see also there's fluctuations over all three of those time periods. So when, for instance, they want to expand the economy, when they want to have an expansionary policy, open market operations will seek to increase the money supply and reduce interest rates in order to promote economic growth. So you can see here the yield to percentage in the yield to maturity in percentages is going to be lower during this period of time. And once again, this is during that Great Recession that happened, excuse me. And so you're not getting a lot of payoff. It's going to take longer for your bond to mature. When we say to mature, that means, for instance, if you were bought, let's just use a savings bond, which isn't the same as this, but it's similar. And this used to be a gift typically from grandparents. Oh, here's a $25 or a $50 savings bond. They paid less money for it, of course. And by the time it matures in 10 or 20 years, they might only pay $20 for it, but we were $50 at the end of its term. And if it has a lower yield, that means it's going to take longer to get there. And if you try to cash it in the meantime, it's not going to be worth as much. That isn't exactly the same as the U.S. Treasury bills and bonds, but there are some similarities. Remember, with each of those, that involves borrowing money in particular. So if lower interest is offered, if interest rates are lower, then more cash is going to stay out into the economy. If interest rates are higher, people are going to want to put their assets into things that have less liquidity, like bonds, for instance. They're going to want to buy more because they can get greater interest off of them. And so if they do that, that ties up more money outside of liquidity where it can be spent easily. So if interest rates are higher, then you're going to see people wanting to make more investments and have less cash on hand. And with less cash on hand, they're going to be buying less. And if they're buying less, people have less jobs. And so whenever there is a recession like this, you're going to have lower interest rates. So people are less enticed to invest and more enticed or attracted to spending their money. And so the Federal Reserve has to be very careful about this policy because, once again, if you just have people spending money, they're not saving anything, they're not investing anything, and that could be a problem over the long run. So they don't want to keep these rates in any one particular extreme for a long period of time. So the Federal Reserve has the ability to control interest rates. And here we can see the federal funds rate. So the Fed can set a reserve ratio, that's one of the things they can do, and require people to keep, or banks, to keep a certain amount of the people's money in their institutions. And so the higher the reserve ratio, the less amount of cash is going to be put out into the economy. The lower the reserve ratio, the more cash is going to be out there being spent. And of course, banks can also seek to borrow from other banks. The rate that the federal member banks charge one another is referred to as, once again, the federal funds rate, or just the Fed funds for short. The rate is indirectly influenced and targeted by the Fed through the channel of open market operations, bills and bonds, and is communicated to the public as the federal funds target rate. So this is put out there, it's not kept secret, and is a standard part of the Federal Open Market Committee communications. So this news is advertised. They don't want to keep it secret, everything about the money supply, about the interest rates, and so on. They, of course, want this to be open to the public. It's important to know the Fed does not set the federal funds target rate. It only issues a range that it targets through active management of the money supply. So it's complicated because it involves the selling of bonds and bills, but there's so much that goes on, they can only get it within a certain range. They can't target a specific interest rate that's going to happen. And so obviously it has to be within a range because of so much activity that's happening with so many different bonds and bills. So the Fed buys government bonds to increase the money supply, because if the Fed goes in and buys bonds from banks, it's saying, hey, I want to buy your bonds, here's some cash. So they get the cash, the Fed takes the bonds. If they want to reduce the supply of money, they do the opposite. They say to the banks, hey, I want you to buy these bonds, here, take them, I'm going to take cash away from you, that's less cash in the economy. So adding to the money supply will typically lead to lower interest rates, while reducing the money supply will increase interest rates. The Fed actively adjusts the buying and selling of bonds to achieve their targeted interest rate. This in turn impacts the rate that the Fed member banks will be willing to charge each other for overnight loans or the federal funds rate. So that's why it's so indirect. It's complex because it involves bonds and bills, and then it has to influence the rate at which the different banks are charging each other, and so there's a lot of different steps that are involved. The federal funds rate will be within a range of a target, so it will just be within a certain range for the reasons that I just explained. And here we can see the federal funds target rate, and the rates, of course, were much higher, as I said, in the late 70s because inflation was high. Inflation was in double digits. It was eating away people's savings. And so they needed to charge higher interest rates to take more money or cash out of the system in order to increase the value of money. And so that's what they did. And interest rates stayed really high. This is a bad time if you were a borrower, like if you wanted to buy a house and get a mortgage, interest rates were incredibly high, especially if you had a fixed mortgage that was going to last over 20 or 30 years. You bought it then, you were in big trouble. And so this was not a good time to borrow. And so that meant since there was less borrowing, there was less spending, and that, of course, caused the economy to cool. And that meant that the inflation happens when the economy is overheated, started to come down. And you can see it did. It took a little while, but eventually did. You can see it spiked back up to 10% here. But for most of the time since 1982, it's been going down. On the average, it's been lower. Look at some of these points here where it has been incredibly low. So that, of course, is when you want to contract the economy. And what about when you want to expand the economy? Because obviously when we go through recessions, we want the economy to expand. We want people to spend more money. And so we want to change the money supply. And monetary policy is based on the relationship between money supply and interest rates. And the interest rate is essential to the price of money. So they are related to each other. So they have an inverse relationship. As a result, the money supply in an economy is increased, the interest rates will generally decrease. And if the money supply is contracted, the interest rates will go up. So here, looking at this, we can see the money supply from one point to another. And this would be the interest rates or the price of that money. And this is the demand for it. So we can see when the money supply is increased, interest rates are going to drop. If money supply was decreased, it was going in the opposite direction of the arrow, then the interest rates would go up. So the money supply is a monetary policy that is available to central bank as part of its authority to help maintain the basics of the economy. So they're controlling inflation, but they're also making sure that the economy is doing well and rebounds from a recession. So central banks use monetary policy to stabilize the economy during periods of economic slowing like a recession, they try to initiate some type of expansion. And the bank increases the money supply in order to lower prevailing interest rates. So increasing the money supply will lower interest rates, more people are borrowing, more people are getting cash then in order to buy cars and houses and expand businesses. So as the cost of money falls, the demand for funds increases, thereby expanding consumption. People are buying more and investing more and spending in the economy. So an expansionary policy involves increasing the money supply. Interest rates lower, people are borrowing and spending more. Banks and other types of institutions that are similar, where people deposit the money, are required to keep money, of course, in those banks. And banks can keep their reserves and cash in their vaults or as deposits within the Federal Reserve. By changing the reserve requirement, though, the Fed can also change the amount of loanable funds. And I expressed this before, when the reserve ratio is dropped, then, of course, once again, the money supply is increased. People are spending more money. That's also part of the expansionary policy. And so all these things can happen in order to increase the money supply that I've gone through throughout this presentation so far. So executing the different ways of controlling the money supplies obviously involves a lot of math. It involves a lot of careful planning. That's why they have all these meetings. And that's why up to the point where they decide to change any of these things, they obviously have to discuss this in closed-door meetings, because you don't want members of Congress or big businesses coming along and pressuring them to maybe increase the money supply too much too fast, because then all of a sudden the economy could swing upward, and then all of a sudden within just a couple months you have high inflation. So they want to keep their decision-making process under wraps, but when they get to the stage where they're actually making a decision is when they release that information to the public. And so the point is the Federal Reserve has to be non-political, and it can't come under the influence of other industries or Congress. They obviously have oversight. Congress can question them, the officials of the Federal Reserve, and bring them in to ask how they're making the decisions, but not while they're making the actual decisions. They're not allowed to do that, because that would influence the money supply politically, and then people wouldn't have confidence in the dollar or the bonds or the interest rates or the banks. And so you have to make that as apolitical or neutral as possible. The last thing I want to mention is the Taylor Rule. The Taylor Rule was designed to provide monetary policy guidance for how a central bank should set its short-term interest rates. And it is named after this guy here, John Taylor, a Stanford University professor. He created the Taylor Rule. He developed a formula, and it was designed to provide monetary policy guidance, particularly to the Federal Reserve. This formula suggests that short-term interest rates, depending upon what's going on in the economy, be used in order to keep the economy stable in the short term. This will help minimize inflation over the long run. So tiny adjustments every quarter, every 3 months, will help lead to a more stable economy. And the rule basically states how much a central bank should change the nominal interest rate, the real rate plus inflation, because that also has to be taken into consideration, in response to changes in prices, changes in productivity, and changes in economic conditions. In particular, it says that a 1% increase in inflation, the central bank should raise interest rates by more than 1 percentage point. So that way they're able to beat it. The factors that it takes into consideration is the level of actual price increases or inflation, how far activity in the economy is above or below full employment, which traditionally has been 4 to 6%. So if it's dropping below 4%, that's a sign that inflation could be happening real soon. For example, because lots of people have jobs, lots of people are spending money, lots of people are going out and buying goods and services and driving up prices if unemployment is low. And it also takes into consideration the level of short-term interest rates that should be consistent with full employment. So if lots of people have jobs, obviously the interest rates, in order to protect against inflation, maybe need to be a little bit higher. And there's lots of money activity happening, lots of cash being spent. That obviously is going to influence what is happening to short-term interest rates. If it's not, then that's a bit of a problem. The Federal Reserve does follow this rule, but not completely, because it obviously has to take other variables into consideration. So, what is the impact of the Federal Reserve? So let's talk about it from the view of the total economy, particularly the impact on aggregate demand, the overall demand for all goods and services, prices in the entire economy, and then the real gross domestic product. In other words, the total productivity of the country. And aggregate demand, once again, just to refresh you of that phrase, is the total demand for final goods and services, the final goods and services. So what is actually going to be demanded, not the ingredients for that product. And in a given time and price level, usually for a year, for instance. So aggregate demand is the sum of consumer spending, government spending, investment, and net exports. In other words, it's going to include exports if they are greater than imports. But that isn't the case right now. We have a trade deficit where it's the opposite. And so if we look at this picture here, we can see aggregate demand displayed, the original aggregate demand, as line AD. And notice it slopes downward just like demand in an individual marketplace. And this is going to be the price level. This is going to be real output. So this is going to be the total productivity. And this is going to be the price level. So those three things that I just mentioned, aggregate demand, output, and then price levels. This is the short run aggregate supply curve. And it starts to slope upward because the long-term aggregate supply curve is vertical. So the short run, as time goes by, it starts to straighten out, because in the long run, it will look like this straight line here marked by this Y and the asterisk. So this graph shows the effect of expansionary policy. Because if we try to expand the economy, then aggregate demand shifts to the right here, as you can see, causing a brief increase in price levels. But notice we are seeing an increase in the quantity of output, so we're going to be more productive. Obviously, if the opposite is done, and we try to contract the economy, the original one would be here, and it'd be shifting down. And this will bring down price levels, because remember, they'll try to contract the economy to control inflation. And so it will bring down prices a little bit, but notice what it also does. It also decreases productivity. So that's one of the dangers of trying to control inflation too much. And so they really have to watch their numbers carefully when they're trying to do that. Something else that can be done that can influence monetary policy is to change what is called the discount window, which allows certain institutions to borrow money from the central bank. In this case, this is looking at the Bank of England, which is their central bank. And this usually just takes place on a short-term basis. And to meet temporary shortages of liquidity, so they want to increase the amount of cash that can be spent quickly, they might decrease the rate charged at the discount window. And so the discount rate will not only encourage more lending, but put downward pressure on other interest rates. And with lower interest rates, more borrowing is happening, more cash is being spent, and so on. And here you can see they definitely did that when the Great Recession was happening, because they wanted people to spend more money and have more cash on hand during that particular recession. And here we can see the business cycle and the impact that monetary policy has on it. A restrictive monetary policy would generally increase unemployment and decrease inflation. So remember, that was the thing that I just mentioned they have to be careful about, because if they try to control inflation too much, they could end up increasing unemployment. But here we can see the business cycle. And here we can see it generally this is a simplistic model. Obviously, it's a lot different than that. Hopefully, over time, it's, as it's going up and down like that, it's over the long run going up at a steep angle. But anyway, and obviously, it's not always as smooth as this. It can be very jagged-edged. But anyway, the expansion period is when productivity is going up in the business cycle. The boom is when we're reaching the highest peak point. That's followed by a contractionary period. Over a short run, it's known as a recession. Over a long run, when it comes to a deep cutting trough, it can be called a depression. Hopefully, it just goes down here, and then the trough is much lower than the previous time, and then it starts going back up. That would be the ideal situation. But anyway, during this period of time is when a central bank wants to start using an expansionary period. And here is where they want to use a contractionary period, because this is where inflation can start to happen. And if inflation gets too high, it itself could trigger a recession to happen because prices go way up. People decide that the economy is unstable. Businesses are afraid about budgeting too far in the future, and they start to lay off, and so it could cause unemployment too. So there are a lot of dangers involved in that period of time. If this is too steep, if it's really steep, if it's really skyrocketing, whenever you have explosive results, you could end up with a big crash that could happen. Some other factors to think about would be the liquidity trap. And this is a situation where putting cash into the economy through the banking system by the central bank, where it fails to lower interest rates, because that is a possibility, and therefore it fails to stimulate the economy. Usually, central banks try to lower interest rates by buying bonds with newly created cash. In a liquidity trap, bonds pay little to no interest, and so they don't have the necessary impact that they thought. So this makes them nearly equivalent to cash because people want to get rid of them pretty quickly. Under the narrow version of what we call the Keynesian theory, named after John Maynard Keynes, in which it arises, it is specified that monetary policy affects the economy only through its effect on interest rates. Thus, if an economy enters a liquidity trap, further increases in the money stock will fail to further lower interest rates, and then they will not stimulate. And so people aren't going to necessarily going to follow the normal rational course of action during this period of time. A liquidity trap is caused when people start to hoard cash because they expect something like deflation to happen. They expect prices to start falling, and so they're going to hoard and keep the cash because they expect to get better deals in the future because of the tumbling economy. This could happen because of a decrease in aggregate demand, the consumption. It can happen because of a disaster or a war. And so people start to save and save and save, and they're not doing any spending at all. So putting more cash into the economy, lowering interest rates, none of that seems to work. And when that happens, there's a real danger of deflation. People don't realize this, but their belief that there will be deflation causes inflation to happen because they're holding all this cash. Nobody's spending anything. And so businesses are going to lower prices, and they're also going to lower wages. People think deflation is a good thing, but it also means the wages are going to go down. And so it means the economy is going to continually tumble downward and possibly be destroyed in a really deep reaching type of recession. And of course, all of this comes under controversy because people will say, oh, look, see, it doesn't work all the time. Or, oh, look, they're having their meetings beforehand. And even though they release the information eventually, leading up to that point, they're being secretive, even though they're trying to avoid politics. But some people say, no, it should involve politics. The average person should have a say in what the interest rates are going to be. But obviously, the math is too complex for that to be possible. But people believe that. And so there are criticisms of the central banking system and the activities that it uses. And probably one of the most controversial times that ever happened was during the late 1970s. That was the time of Paul Volcker. He was the 12th chairman of the Federal Reserve because it's a 20th century invention. And when he did those things that I mentioned earlier, when he jacked up interest rates considerably to help fight inflation, there was a lot of controversy because unemployment went up and a lot of people lost jobs, and people were having that did have to take out, loans. I absolutely need to buy a house because I have a family, I have children on the way. They were having to borrow at incredibly high interest rates. So there was a lot of criticism during that period of time, and it was incredibly controversial. Alan Greenspan, on the other hand, when he was at the Federal Reserve helm as the chairperson, he was generally celebrated because there was huge amounts of growth during the 90s thanks to the technology boom, but interest rates were kept pretty low thanks to the Federal Reserve. It was actually after he left office that he got most of the criticism. Because all of this incredible growth, people were buying houses left and right. People that normally couldn't afford houses were buying. Interest rates were low, and so lots of people were going out and buying houses for a lot more money than they could afford. Maybe they're only making $80,000 a year, but they were buying a house for $400,000-$500,000. And so a lot of people then created this housing bubble where it kept growing and growing. And then other industries started investing in the housing market. And lots of people started throwing their cash into real estate. And lots of insurance companies started to insure these mortgages and loans that probably weren't made in the best interest. And so this created an overheated market, a big bubble that eventually burst. And that's what caused the financial crisis in 2008, 2009. And so he got a lot of criticism after the fact because they said, well, you were keeping inflation low, but you weren't watching this particular part of the economy to see if it was inflating too much. Because some people started to say, well, the Federal Reserve should be watching out not just for the inflation of general prices, but also particular parts of the economy that exist. Now, after Greenspan, Ben Bernanke took over, and he had to deal with some of the financial crisis that was happening. And so, particularly, the appointment by President Obama by Ben Bernanke, he wanted to reestablish the economy, but he didn't want it to blow up really fast because he said, "Look, that will be great in the short run, but then we'll just have another big crash." So he wanted to do it through moderation, which was one of the criticisms of President Trump. He wanted to know why is the economy only growing 2 to 3% when it should be growing 4, 5, or 6%. Well, the Federal Reserve's response was, well, that could be dangerous if we let it grow too fast. It could overheat again and implode. And that is one of the controversies. Do we want people to make quick cash and pay for it painfully every 7, 8 years? Or do we want moderate growth to happen? And that is a debate that is going to continue to occur for a long period of time, no matter who the central bank chairperson is.